Is Roku Roku? Well, in this video, we're gonna figure out if that is the case. We'll do a deep dive on Roku and find out if it's a good investment at current prices. What is going on YouTube? Welcome back to my channel. My name is Riado, and in this channel I talk about some of the most innovative companies in the world, and I help you guys find the companies of tomorrow. If that is something that you like to hear, don't forget to subscribe to my channel so you won't miss future videos. If you like to read the article version of this video, you can find the links to my article in the description down below. With that said, let's get started. So, quick story about Roku and how it was founded. Roku was founded in 2002 by Anthony Wood, which is the current CEO of Roku. And in 2007, Reed Hastings, the CEO of Netflix, he decided to invite Anthony Wood to join the company so they could develop a streaming player for Netflix. So in Netflix, Anthony Wood was tasked to create the Netflix player, which you see in this screen right here. And it was a very top secret project, and it was called Project Griffin at that time. But a few days or weeks before its official launch, Reed Hastings decided to scrap the entire project and decided to not sell hardware or the Netflix player. So the reasoning behind that is that launching a hardware device will be viewed as competitive to its distribution partners, which are TV brands such as Samsung, LG, Sony, and so on. And therefore, if Netflix launched the Netflix player, it's going to be viewed as competitive and there's going to be conflicts of interest. So a few months later, Netflix decided to spin off Roku in 2008, and in exchange, it has a 15% equity stake, leaving Anthony Wood with a few Netflix employees and a few cash in hand as well. And then a few months later, Netflix decided to sell its entire stake on Roku. So they booked a gain of $1.7 million over a $6 million investment on Roku. So if Netflix held on to their shares of Roku until today, it will be worth billions of dollars. And now the question is, what makes Roku a multi-billion-dollar business? So with that out of the way, we can now talk about Roku as a business. So in a nutshell, Roku is the leading TV streaming platform for consumers, advertisers, and content publishers. Roku sells streaming devices such as streaming dongles and stream bars, which can be easily connected to a TV, so consumers can start viewing content and streaming content immediately. Roku also works with TV brands and TV manufacturers to sell co-branded Roku TV models with built-in Roku OS. And keep in mind that all streaming devices sold by Roku all have the Roku operating system. So with the Roku OS, consumers have access to media and entertainment content. They have access to thousands of channels ranging from live TV, sports, news, movies, and even streaming music. Some of the channels include Netflix, Spotify, Prime Video, and so on. There's also the Roku channel, which is an ad-supported channel developed and operated by Roku, and it offers free content including live TV, movies, TV shows, and even original content offered by Roku through Roku Originals. And last but not least, the company offers advertising services to enable marketers to display relevant ads and reach highly engaged audiences. And ultimately, advertising is where Roku makes most of its money through its platform segment. It also makes money by selling streaming devices, which is called the player segment. So turning to the market opportunity for Roku, Roku benefits from the cord-cutting trend where consumers are switching from cable TV to TV streaming. So according to Insider Intelligence, pay TV households, which are pretty much people or households that use cable TV, penetration rates are expected to drop from 52.4% in 2022 to just 42.4% in 2026. So that's a massive drop, and each consumer that leaves pay TV, they're going to migrate to connected TV, which is the category that Roku is operating on, and it's going to benefit Roku in the long run. And here's another chart by Insider Intelligence. It shows US connected TV ad spending between 2019 to 2024. Insider Intelligence estimated that Marketers spent $14.44 billion in connected TV ad spending, and they're expected to grow all the way to $29.5 billion by 2024. So this is another tailwind for Roku as more marketers ramp up their ad spending on connected TV platforms such as Roku. And also, according to Roku in its Q1 shareholder letter, reach on TV streaming finally surpassed legacy pay TV in the US for the first time ever. In Q1, the average weekly reach for adults aged 18 to 49 who stream TV was 65% as opposed to legacy pay TV, which was only 63%. So I think the trend is going to continue. Streaming TV is going to go up all the way to 100%, and legacy pay TV will eventually be obsolete and will reach 0%, in my opinion. And the reason why cable TV is still prevalent in today's market is because of the fact that most of these cable TV providers, they have exclusive contracts with sports associations such as MLB, NBA, and that is the reason why people are still opting for cable TV instead of connected TV. And as you can see here, the SVP of Roku during the earnings one call mentioned that sports is the last pillar holding the traditional pay TV bundle together. And as more sports become available through streaming services, we should see acceleration of consumers out of traditional pay TV and eventually an acceleration of people moving into connected TV platforms such as Roku. So I think that is the case. Live sports and the contracts that cable TV providers have will eventually expire, and that could be the final nail in the coffin for cable TV providers. So turning to the growth of the company, total revenue grew 28% to $734 million in Q1. This is a slowdown from 70 to 80% growth rates during the early days of the pandemic. And we know for sure that the slowdown is due to tough year-over-year comps as well as the reopening of the economy. But again, 28% is still a robust number, and it shows the strength of Roku's platform as well as the demand for connected TV. But if we break it down by revenue segment, platform revenue actually grew faster than total revenue, which grew by 39% to $647 million due to higher advertising demand in the platform. However, player revenue dropped by 19% to just $87 million. So we can see that the last few quarters has been negative year-over-year growth for Roku and the player revenue segment. So this is due to a lower volume of streaming devices sold as well as lower average selling prices. For me, I'm just focusing on the platform segment, which is the higher margin segment, and it grew by 39% despite very tough year-over-year comps, which doubled in 2021 Q1 last year. So it just shows that management is really executing, and there's a really high demand for Roku's platform. For active accounts, Roku grew active accounts by 14% to 61.3 million active accounts in Q1. We can see that Roku continues to add active accounts quarter over quarter, which shows again a very strong execution by management as well as the demand for connected TV. However, we're seeing a slowdown in growth, and this is again due to tough year-over-year comps, supply chain constraints, which causes rising TV prices and therefore lower TV sales and subsequently lower account activations. However, it is very encouraging to see Roku continue to add active accounts quarter over quarter despite the tough macro environment that we're seeing today as well as tough year-over-year comps. Streaming hours in the platform grew 14% to 20.9 billion hours in Q1. Again, this is not the kind of growth rates that we're accustomed to see during the early days of the pandemic. The slowdown in growth is due to the reopening of the economy, and we can expect streaming hours to drop quarter over quarter in Q2 or Q3 as people start to travel and spend more time outdoors during the summer season. However, I think the opportunity to grow streaming hours in the platform is still very attractive. According to management, Streaming hours per active account per day was 3.8 hours globally in Q1 versus the average US household, which consumes approximately 8 hours of TV per day. So I think there's still a lot of room for growth in terms of streaming hours, and higher streaming hours means better advertising opportunities and therefore higher platform revenue for Roku. Now, if we look at average revenue per user, ARPU grew 34% to $42.9 in Q1 due to strong advertising demand, and it also shows the high bargaining power in the advertising platform that Roku offers. And more importantly, it allows Roku to insulate consumers from inflation and sell streaming devices at lower prices to increase account activations. So all in all, I think Roku is showing strong growth numbers, especially in terms of ARPU as well as platform revenue, which are, again, I think those are the two most important metrics when looking at the growth numbers of Roku. With that said, I believe Roku will be able to sustain growth rates of 20 to 30% over the next 2 or 3 years, given that people are still cutting cords and migrating to TV streaming. So turning to the profitability of the company, gross profit grew 12% to $365 million in Q1, which is a 50% gross margin. We can see that gross margins have been improving over the last few years, and this is due to higher platform revenue as a percentage of total revenue over time. However, we can see that the 50% gross margin in Q1 was lower than the 57% gross margin achieved last year. And if we look at gross margin by segment, we can better understand why overall gross margin is declining. As you can see here, gross margins for both segments have been declining over the last few quarters. The decline of platform gross margins from 67% to 59% was due to greater mix of video ads, which have lower gross margin profiles. And for the player segment, gross margin have been in negative territories, and this is due to supply chain issues and inflation, which causes higher manufacturing costs as well as shipping costs. Additionally, I think player margins will continue to be negative in the next few quarters or even years as management is focusing on account acquisitions as well as insulating consumers from higher costs. So turning to operating profit, we can see that the company has gone from losses to profitable to back to losses as of Q1, which is a negative 3% margin. Of course, this is due to the lower gross margins as well as higher R&D and sales and marketing expenses that the company is ramping up on. However, if we adjust for non-cash expenses, we can see that adjusted EBITDA margins are still positive, which shows that the company is still making money and they're not burning cash. So overall, I think the company's profitability metrics are still very volatile, so I'm not seeing any economies of scale or operating leverages. The company is also sacrificing short-term profitability for long-term growth as management is increasing spending to reinvest into growth. However, I think the higher margin platform segment is going to continue to grow and is going to continue to make a greater portion of total revenues, which is going to improve Roku's overall margin profile. Turning to the balance sheet of the company, Roku has $2.2 billion of cash and short-term investments with $576 million of total debt. So that makes their net cash position to about $1.7 billion, and the company has about a current ratio of 4 times, which I think is very healthy in my opinion. The large spike in net cash in 2021 Q1 is due to the company raising equity, which they have a gross proceeds of about $1 billion. In terms of free cash flow, we can see that free cash flow margins have been improving. However, we may see free cash flow margins worsening as the company ramp up investments as well as due to supply chain constraints. So not much to say here, but Roku's financial health is in good standing. It has a high net cash position as well as positive free cash flow. So I don't see Roku, raising debt or raising equity in the foreseeable future. So turning to the outlook of the company, Q2 revenue is expected to be $805 million, which is a 25% year-over-year growth. The slowdown in growth is due to a potential to reduce or delay ad spend in certain verticals. The company is also facing a very difficult comp where platform revenue in Q2 of 2021 more than doubled year over year. Actually, platform revenue grew 117% in Q2 of 2021, which is why there's a massive deceleration in growth in Q2. Q2 gross profit is expected to be $395 million, which is an increase of 17% year over year. This is a 49% gross margin, which is lower than the 50% gross margin achieved in Q1. This is due to the company continuing to grow the portion of video advertising, which has slightly lower margins. Supply chain disruptions are going to continue to pressure the player business, and management is going to continue to prioritize the account acquisition and absorb elevated costs. Q2 adjusted EBITDA is also expected to be break even as the company invests in the business. Operating expenses is expected to increase approximately 90% year over year, and the company expects full year adjusted EBITDA of roughly $150 million, which is a very steep drop from last year's $465 million of adjusted EBITDA. And last but not least, management expects total net revenue growth of approximately 35% year over year growth, which is a $3.7 billion revenue for 2022. And what this means is that there's going to be a re-acceleration of growth in the back half of 2022, and I think investors are going to react positively in terms of the rising growth rates. In terms of competitive moats, I think the company has a really strong brand. It is recognized as the #1 TV streaming platform in the US, Mexico, and Canada by streaming hours, so I think it's safe to say that the company has one of the most powerful brands in the connected TV space. The next moat is scale. The company has 31.8% market share globally as shown by the chart right here. As you can see, Roku has 31.8%, which grew by 0.7 percentage points from 2020 to 2021. There are other competitors such as Amazon, Samsung, LG, Android, and Apple, but I think they're just way too far away from Roku at this point. Roku also have a 41% market share in North America, which I think is the most important market for Roku, and they also have a very small market presence in the different regions here in Africa, Asia, Europe, Oceania, and South America, and this provides a long growth runway for Roku in my opinion. So I think the reason why Roku is able to achieve and sustain their market share in such a competitive space is because of the fact that they are service agnostic and brand neutral. For example, TV brands are more likely to use Roku OS as opposed to Samsung OS because Samsung is a direct competitor to other TV brands. Another example is that retailers such as Walmart or Best Buy, they are more likely to advertise on Roku's platform as opposed to Amazon's platform, which is a competitor to them. So I think being a service agnostic and brand neutral platform is one of the big reasons why Roku is able to achieve scale and able to sustain that position as the market leader. The next moat is network effects. I think the company continues to land deals with content publishers, and as more content is available in Roku's platform, more consumers are going to Roku's platform, more advertisers are coming to the platform, and more TV brands are going to use Roku OS. So I think there's a flywheel effect there, and it's going to be a massive network effects for Roku. Roku also recently launched a partnership with Shopify to enable its 2 million plus merchants to start advertising in TVs, which I think it's something that the larger players, the larger businesses have access to historically. And last but not least, I think the company has a solid distribution strategy. It is partnering with TV brands to license its Roku OS. It is also working with Amazon, Walmart, and Best Buy, which they have massive retail presence, and so that should increase the brand presence of Roku as well. And the last mode is switching costs. I think for consumers, TVs are not easily replaced, and for advertisers that spend $1 million or more in Roku's platform, there's 96% retention rate, which shows how strong the company's platform is for advertising. And also, the company is they have the best TV OS, they have the largest scale, they have the highest market share, and I think it's a no-brainer for TV brands to use Roku OS as opposed to other operating systems. So in terms of valuation, I think Roku stock price is priced as if the company is going to go bankrupt. Well, I don't think that's the case. Roku is still a fundamentally strong business with long growth runways, and I think the margin of safety is really large right now. So as you can see, Roku's valuation multiples have compressed as of late. Roku's EV to sales multiple is at 3 times right now, which is at the lowest level ever seen, right? And the company has historically traded as high as 25 times. So I think there's a very large margin of safety for investors today. It is valued much lower than the March 2020 crash right here, and if the company returns to just 5x, it's an almost double from this current level. So I think the risk to reward is very attractive in my opinion. And here we can also see the same thing for EV to gross profit, which is at the lowest it has ever been, and I think it's a very good entry point for long-term investors. On a side note, institutions have been buying the dip here at the lows right here, so I think it should also give reassurances for investors who want to buy Roku. Now, turning to the risks of the company, I think supply chain constraints is one of the major issues, as the ongoing supply chain issues is going to put pressure on ad spending, margins, and account growth. Another risk worth considering is SVOD saturation, which is subscription video on demand. So an example of a company that operates in the SVOD category is Netflix, and as you may have known, Netflix have reported really bad Q1 earnings. Global streaming paid memberships for Netflix dropped quarter over quarter for the first time ever in a decade, and the company is also forecasting the trend to continue here as it drops another 2 million subscribers quarter over quarter. So the loss of Netflix subscribers can be a symptom of a larger issue in the TV streaming industry. And the last major risk is competition. So as you can see from this chart, it shows growth in viewing time for big screens in Q4 2021. Roku grew 12%. However, there are companies like Samsung, LG, and Android TV that grew much faster than Roku. And there are also brands such as Amazon and Apple TV in the connected TV space. So investors should be wary of that and should pay attention to whether these big brands are going to take market share from Roku. However, back to my discussion on competitive moats, I think the company has a service agnostic and brand neutral platform that sets it apart from competitors. And this coincides with what CEO Anthony Wood said on Q3 earnings call. In the earnings call, he said, Roku built the world's only purpose-built operating system for TV, and competitors, they generally take mobile operating systems and port them to TV. So Roku is always building the best possible operating systems just for TV, and they're maniacally focused on that. So I think Roku's obsession of being the only purpose-built operating system for TV is going to set them apart from competitors. So what is my overall thesis on Roku? I think it's very simple. We're going to reach a point where there's going to be 0% cable TV, and then there's going to be 100% TV streaming. And Roku is in a very good position. They have a 31% market share, and they have the best TV operating system in the world. And they're going to benefit immensely from this cord-cutting revolution. Yes, there are competitors, but Roku is the only purpose-built TV OS that is service agnostic and brand neutral, and that should set Roku apart from its peers. Despite the sell-off, Roku's fundamentals remain strong, and there's a long growth runway ahead for the company. And I think the sell-off is overdone, and it gives long-term investors a really good margin of safety. So I think it's a good time to start accumulating shares of Roku. As for me, I have a small position in Roku and I intend to add more shares on price weakness. Well, that's it for me today, guys. Thank you so much for watching this video. If you do like the content, please leave a like, comment, and subscribe to my channel so you won't miss future videos. Thank you guys, and see you guys on the next one.